This changes everything. I'm your host, Steve Van Metre, and thanks for joining me today. A leaked report confirms everything. We said this was going to happen, and now they're about to nationalize an entire sector of the economy. Let's over at CNBC, where we picked today's story up with a headline: Chinese real estate stocks surged this month, but analyst warns of weak reality versus high expectations. Now, I want to take you back a little bit to where this story is going, because you may remember that the Chinese real estate market was massively overheating, and President Xi stepped in and said, look, I want to get rid of all of this speculation. We're going to put in some new controls and curb this demand of speculation. To do what? You've got it to bring demand down to where the level of supply is. And does this sound familiar? Well, it should. The Fed is saying the same thing about the U.S. economy. But what happened in China, as you may recall, the developers started running out of money. The banks panicked that they weren't going to get their loans paid, and the public stopped making payments. And then we said it's either bailout or bust. We knew this was coming. Shares of Country Garden, the biggest Chinese developer by sales, more than doubled in November. Meanwhile, iron ore futures surged by 16% this month because China's steel consumption, nearly 40% of it, is used in property construction, indicating that something under the covers has changed. And the situation is one of those strong expectations, but weak reality and market prices have deviated from the fundamentals. Shang says it's important to watch whether apartments can be completed and delivered during the peak construction period of March and April. And all he's trying to tell us here is like, look, maybe prices are getting ahead of this story. The probability here is that maybe they're actually not. We'll see what's going on, because when you see what they're doing over in China, it's going to blow you away. I know you said this was going to happen, and it is. The new measures, here we see widely reported in China, but not officially released. Key words not officially released: stipulate loan extensions, calls for treating developers, get this, the same whether they are state-owned or not, and support bond issuance. What is that key translated into? Nationalization without them nationalizing the property sector. Look, we knew this had to happen because President Xi said, look, we're not going to come to the bailout here. We're going to let them stand on their own. We're going to let the system do what it needs to do. And in the end, we knew that governments, central banks, they can't do that, because at the face of an entire collapse of an entire sector, and of course we know that real estate is a key sector, not just in China, but also in the US, you let the real estate market go, it tanks your whole economy. But I want you to understand what they're doing here. They're having the developers now as quasi-state owned without an official statement. So imagine this: you're a property developer. Now you can walk into the bank and say, hey, you know those loans we're past due on and the ones we got payments coming up? Yeah, we're not going to make them. You know what? We'll get back to those at a later date, because now we're effectively state owned without being state owned. And oh, by the way, we need to raise some money. So we want you to issue a bond and go out in the market and get us some money. And oh yeah, you can tell those people we're state owned, but we're not quite state owned, meaning we're backed by the government. Go get us some money, because now we need to get these houses and apartments done, because now we're fully backed by the Chinese government. The reality is a temporary relief in terms of the developers having to meet less debt repayments in the near future. Or how about no debt repayments? Because let's face it, if you were given government, quasi-government provisions here, would you make your debt payments? Or would you just go to the banks and say, hey, I'll get back to you in the future. I'll make these payments when I'm ready, because don't worry, I'm backed by somebody with an unlimited purse string. And yes, you can bet the developers are going to do that. A temporary liquidity relief rather than a fundamental turnaround, and that's true. It's just giving the developers what they need, and that is time and the ability to go raise money, because if this policy is implemented promptly, it will stop the downward spiral to the developers, and this will restore the investors' confidence in the developers. And of course, you know where that is going. It's price. You know, we talked about how the real estate market is very price sensitive. When prices are falling, people tend to buy less. And that means prices tend to continue to fall until something comes along and changes and puts a halt to that. We know that's going on in China, and the government's finally woken up to the reality that they can't let this thing blow up. Adding to those worries, as I mentioned, falling prices, housing prices across 70 cities fell by 1.4% in October. And despite more local housing easing measures in recent months, because it's already started and they haven't been able to stop this, so now we have to look at nationalizing the entire sector. The analyst said, we believe the property markets in lower tier cities still face strong headwinds from weaker growth fundamentals than larger cities, including net population outflows and potential oversupply problems. But hey, if you don't have to make your payments and you're quasi-nationalized, no worry, the developers will be back at it soon enough. And about 2 years ago, Beijing began to crack down on developers' high reliance on debt for growth. And the country's most indebted developer, Evergrande, as we covered extensively on the show, defaulted late last year in a high-profile debt crisis that rattled investor confidence. And when we talk about what's going on here, and we see this in history, if you study monetary history, what do you find? That when central banks or governments expand through the economy, through cheap money, through low interest rates, they blow these big bubbles and then they try to slow them down. But now think about what we have around the world. We don't just have monetary stimulus that blew the bubble, we also have fiscal stimulus. So all these governments blew these massive bubbles and they're trying to just deflate them a little bit. And what they find as they start to deflate them, they risk popping the whole thing and blowing everything up. So it comes back to, do you continue to maintain the status quo and go back to easing measures, or in this case, just potentially nationalize your entire housing market, or do you let things blow up? And of course, we know when push comes to shove, the blow up option gets pushed off the table. And Wall Street loves this as they want President Xi's many markets to come back. The dramatic about-face comes as Beijing seemingly shifts toward a more pro-growth footing, tweaking COVID policies to minimize economic and social costs, delivering a plan to rescue the property market, and dialing back tensions with the West. The result, mainland shares are up more than 7% in this November. But here's the key part I want to focus on, we're going to dig deeper into, is while the yuan is on pace for its first advance in 9 months. That's right, we're going to talk about this currency here in a moment, with concerns that monetary policy tightening in the U.S. and Europe soon could tip developed worlds into a recession, and foreign firms are increasingly looking to China as a key portfolio hedge. And of course, you know as well as I do, is when the banks get really excited about dumping their assets off onto other people, they start pumping about how that's the next place. So you can probably guess that some of these investment banks are sitting on stuff in China they'd love to unload because they're not sure if this will play out in favor or not. And if you can get rid of it while you have a chance, well, they'll do it every day of the week. But amid the first annual foreign portfolio outflows in more than 2 decades, and one of the nation's biggest ever stock market routes, China's leadership appears to be, if not acquiescing to the appeals of global investors, at a minimum heeding their concerns. And this is a big issue in China because in the U.S. as a global reserve currency, we can export dollars. We need to export dollars so we can see capital outflows. But in China, even though they're a major industrial power, they're still in an emergent state. They need money to flow in. So anything they can do to turn that tide, and now you're starting to see it. They've seen capital outflow. There is a major shortage of dollars. They don't like it. And now they're forced to deal with that and try to pull capital back in. And how do you do that? What's the best way to do that? Well, just nationalize an entire sector of your economy. And as long as the government's backing and printing the money, well, money, of course, capital will flow back in, and that could lead to a change, at least the direction of where the dollar's headed. And that is a big move to come. As fund managers are now turning ever more pessimistic on the U.S. dollar, and this is key to a broader story here now, the dollar's exceptionalism premium is receding as the Fed approaches maximum hawkish. Again, the view being that the Fed drives the value of the dollar, which is not the case, but still the popular narrative. The safe haven premium is also falling as the backdrop improves, with Europe energy situation looking less dire. Now, what they're not talking about in these articles is of what going on in China. Now, they will in the future. They'll get to that. But I want you to be thinking about this. If the yuan goes up in value, and what could cause that? Well, demand for it. Capital flow coming back into China. The property sector reviving. Demand for yuan means potential weakness for the dollar, less demand for US dollars. Because remember, we talked about how money was flowing out of China, and where was it looking for a safe haven in? That's right, in dollars. So now we could see the dollar start to weaken here. And this is a pretty big issue, because if you missed the Sunday show, I want you to go back and watch that and now put into the context a weaker dollar here. Because remember what China did. They told their banks, we want you to dump the dollars onto the market, and we want you to take speculative positions on a rising yuan. And we said, they're going to do something. It's something, either they're going to blow up the banks or they're going to come to the rescue. And here you see it, nationalizing their real estate market. Bam, all of a sudden, yuan goes up, dollar goes down, and that puts a big tailwind behind the U.S. equity market in the future. And that's why I want you to go back and watch that Sunday show and put this all into context. And here we can see this kind of notion that the CPI leads the bond market. Well, that's not necessarily true. In fact, throughout history, what we have here is the CPI in blue and 10-year treasury yields, both on a year-over-year rate of change. And we tend to note that yields lead, of course, the CPI. There are periods of time, such as now, where that doesn't happen. But broadly speaking, yields lead inflation. In fact, we can tell that inflation is likely peaked based on the yield curve. Now, I've got the 2-10s yield curve, which is 10-year treasuries less 2-year treasury yields, shown inverted in red, and we can see the peaks here, which is where it's showing inverted. As that comes down, inflation then is likely to follow. So we're potentially seeing a peak here in the 2-10s, and what we want to see is 2-year yields start to fall, indicating that inflation is then pretty much done. But how does that translate to the dollar, you ask? Well, it does in a big way. Here we've got that same 10-year, 2-year yield curve, also shown inverted in blue against the nominal broad US dollar index. And notice a nice relationship here. You start to see the yield curve steepen, again shown inverted. And what does that mean? It means the dollar weakens, puts a tailwind under US equities, puts a tailwind under commodity prices, puts a tailwind under things like gold and other assets. And all of a sudden you can even see yields start to fall here. And that's why you're not going to hear anything from the Fed about this. But China needs this. We said they'd have to, but what is the Fed likely to do? Well, let's take a look. Fed's Bostic favors slower pace of rate hikes ending near 5%. Bostic's plan was shift away from the big 75 basis point hikes and continue to raise rates as much to 4.75 to 5% over the next several meetings, despite the fact that the bond market doesn't believe him at all, which he describes as a moderately restrictive landing rate where the Fed would go on hold for an extended period. So I want you to see now, going into this December meeting, which is mid-December, so we still get another payroll report, we get another CPI report, that already we're seeing speakers talk down these big hikes. They still want to hike, but now we're starting to see perhaps December, they're talking about there'll be a hike, and maybe in January, February, perhaps even as late as March, and then done. They're talking about scaling this down, and it's ending, and that view also takes pressure off the dollar here. My baseline outlook is that the macro economy will be strong enough that we can tighten policy to that point without causing an undue dislocation in output and employment, despite the yield curve telling us just the opposite is going to happen. And I do not think we need to continue raising rates until the inflation level has got down to 2% because of lag dynamics that we've completely ignored. This would guarantee an overshoot in a deep recession, which then becomes a likely case, because now we'll look at the 10-year 3-month yield curve, and it's predicting pretty much that we are imminently likely to see a recession in a matter of perhaps into sometime maybe late first quarter into second quarter next year. And other signs the economy slowing, the Chicago Fed National Activity Index noted it came down into minus 0.05. And you say, well, Steve, that's a pretty small number. Remember, this doesn't move very much, as 0 is on trend. 3 of the 4 broad categories of indicators used to construct the index made negative contributions in October, and 3 categories deteriorated from September, indicating that everything the yield curve is telling us is true, that the future growth and expectations expectations in the U.S. economy is slowing. The only question is when do central banks figure this out? And here you can see on this chart the trend of the Chicago Fed National Activity Index indeed slowing down, putting us on trajectory for a recession sometime to start next year. The only question now is how fast will the Fed react? Because we know the U.S. government isn't likely to nationalize anything, but just wait. It won't be long before we get the official word from China that their property market is now state-owned. I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.